I mean, Mark, is there really no yield curve control? Really?
Front end of the curve through their forward guidance. They were very, very dovish yesterday and signaled that there's going to be no rate hikes coming anytime soon. I think the back end of the curve is more influenced by risk sentiment and what we see is happening with the virus. There's still a lot of uncertainty about how the virus will progress, and the back end really seems to be moving with risk and the general outlook for the virus in the U.S.
Mark, is there a level at which that will change? If we see a spike in yields in the middle of the curve, do you think the Fed steps in? Is there a kind of a tolerance point here from which we can start to assume that there will be some sort of yield curve control?
Yeah, it's a great question. And I think what a lot of investors have been asking is there a level that the Fed cares about at the back end of the curve where they will step in and really try and become more aggressive and think about potentially trying to buy more or maybe implement yield curve control at the back end? And in my view, the answer is no, there's not one particular level, because what we think the Fed is looking at is that they're looking at what's driving the increase in rates. Is it good factors such as better global growth, higher inflation expectations, or is it not so good factors? Is it due to too much Treasury supply, or is it due to weak investor demand? I think that if the drivers for the back-end rate increase are due to healthy factors, the Fed is going to see that as a very positive development. Where they will step in, however, if there is a disorderly market move, if you see longer-dated real rates rising, or if you see trouble digesting all of the Treasury supply in the market. And I don't think that the Fed sees that right now. So they're likely to look at yield curve control more towards the short-dated part of the curve or the intermediate-dated part of the curve. And what they really, if they adopt yield curve control, which we think they will, but if they adopt that, what they're really going to be doing with yield curve control is reinforcing the fact that the Fed is not going to be raising rates at any point soon, and that they are going to remain very, very dovish until they can make better progress on their employment mandate and also see inflation begin to move to the high side.
So, Mark, where does that leave steepeners?
So we still think that they make a fair amount of sense here, especially when you look at the belly of the curve. We think to the 5 and the 7-year part of the curve will actually, in all likelihood, decline further from here as the Fed talks a little bit more about yield curve control, likely hints that they are still leaning in that direction, and hopefully ultimately rolls it out. And if they do yield curve control, we think that they'll probably only do it out to the 3-year part of the curve, but they're going to do it with forward guidance that should suggest that rates are not going to rise for an even longer period of time. We think the market would likely extrapolate the type of forward guidance that the Fed will roll out to about the 5 or the 7-year part of the curve. And if that's right, then steepeners should work, because you're going to be suppressing intermediate dated yields and hopefully raising higher inflation expectations towards the back end of the curve. Now, importantly, we think that the type of forward guidance that the Fed will employ will be linked to inflation, and it will be some type of average inflation objective over time. We know how hard it was for the Fed to hit inflation in the last economic expansion, even with pro-cyclical fiscal stimulus, the Trump tax cuts. And so it's going to probably be even more challenging for the Fed to hit their inflation mandate in the next cycle. And so that's why we think that the market will extrapolate this very, very dovish tone from the Fed, not just out to the time horizon over which yield curve control would extend, but probably to some period of time beyond that. And that's why I think you saw the belly yesterday outperform, because the Fed was being very, very dovish. They were very clear that they have no intention to raise rates, not even thinking about it, according to Chair Powell. And we think that that should still support the intermediate part of the curve. The back end of the curve will hopefully move higher with improved inflation expectations and improved expectations for economic growth. And again, I think that would be more of the healthy rate rise that the Fed would like to see.